Hey, Rent to Retires. Thank you so much for joining us. We are here today with Sam, one of the Rent to Retirement team. Sam, how are you today?
Fantastic, Adam. Thanks for having me. It's a pleasure to be with you.
Absolutely. It's awesome to do our first episode together. And we have Sam put together quite the state of the market for us. This is a state of the market for September 2021. And it's a busy market. I think it's fair to say.
Yeah.
It's gotten a little bit busier. It's starting to get a little bit slower for the single family homeowners, the single family buyers, not for investors for the most part, but single family buyers. I think it's safe to say it's slowing down a little bit nationwide. I should say nationwide, it's slowing down a little bit, right?
Yeah, definitely. It all depends on your perspective and where you're coming from, whether you're an investor or just looking for a place with your family. But yeah, I thought today would be a good time to go over things as a realtor myself out here in Wyoming and check in on the whole nation as a whole.
Yeah, absolutely. So how long have you been in the real estate business?
Yeah, so I actually got into real estate in college, and that wasn't too long ago, actually, just about 3 years. So I started managing apartment buildings in Madison, Wisconsin, big college town, and it's the capital of Wisconsin. And I was doing leasing and some handyman work, and then got into luxury property management, and then eventually into sales, where I am now.
Nice. All right, so let's go into the state of the market. Now, Sam sent me some numbers that really blew my mind because I remember doing videos and podcasts about a year ago talking about how the median home price in the U.S. was a whopping, and it was like $320,000 or something like that. Maybe it was 2 years ago that it was, but it wasn't that long ago that people were saying, "Oh my gosh, the median home price is over $300,000." Well, in today's world, it's a bit more than that. Safe to say, we are looking nowadays at $380,000. That's getting up there. That's not investor pricing at this point, huh?
Yeah, definitely. I think a lot of the high end stuff has been pushing up that median home price. But yeah, I mean, that doesn't seem super affordable for a 24-year-old like me.
Yeah, and that's up 9% year over year, which we've seen appreciation out of control in certain parts of the country. I mean, you look at like especially parts of Idaho, like Boise, it's probably 40-50% inflation, I believe. Yep. Where I am, it's in the mid to high 20s. This is really kind of dragged down, quote unquote, by the big markets that were hit. New York, LA, those type of places with the pandemic that dropped it down. So if you cut out the higher places, I'm willing to bet year over year it's even better than that for people doing this. And I want to go into kind of why the median home price being what it is could be really important for people. And it's a good thing, actually, especially if you're looking to actively utilize your home. And what you can do with this, the reason I'm saying that this could be a good thing is more look at your home as a potential investment. I mean, obviously, when you're living in it, you've heard people say if it doesn't put money in your pocket, it's not an investment. Well, your home can put money in your pocket, and especially in today's world, as your home appreciates and you have these incredibly low interest rates, your home can be a cash out refi opportunity for you, where you pull out enough money to buy 1-2 properties that can then put money in your pocket month to month. And this increasing median sales price, looks bad if you're looking to buy a new home, potentially. In some markets, it's gotten so expensive. But it's also given you the opportunity to really cash in on your home price value rising. What do you think, Sam?
Well, yeah, I like that you said that. And it's not all about cash flow, even though us as investors here at Rent to Retirement, that's our main emphasis. Like if inflation is going to be, this is a macro discussion, but if inflation is going to be at 10% with your cost of living and food and everything else, and you're able to lock in a 30-year fixed rate mortgage at 2, 3, even 4%, you're already making a 6% return right there. So think about, all those other ways that you could be making money on your home instead of just a traditional asset Kiyosaki way of looking at it.
Yeah, and especially, I mean, you just look at it as the Fed straight up tells us, no holds barred, they target 2%. That is their target. They said they're going to look at that. They're going to average it out over a few years. 2% is their number. So worst case, if the Fed actually does what they're, or best case, I would say, if the Fed actually does what they're setting out to accomplish, that's 2% every single year. So, I mean, right now, you can do a cash out refi and get, in the 2s or 3% there. So you're really only, 1% off of that every year just on your interest, not even counting any potential appreciation on your home. So just wanted to give that as a clarification of, hey, homes are getting more expensive, which if you own a home right now can be good. And if you're not owning a home right now, you can still get value in the fact that, your rents aren't going to rise as fast as the median home value are at the moment, because homeowners and investors can't push their rents up as fast as prices are rising right now. It'll be several years before that happens. So you'll have time to build up a down payment if you need. So let's go to days on market. I don't know about Jackson Hole where you are, but in Austin, days on market is feels like it's about -3. So
Yep.
Nationwide, we're seeing 39 days, you said, which is down 30%. That's a year.
Pretty crazy. Yeah. So like you mentioned, Austin and these really, really smoking hot markets, some stuff is even trading off market, right? It's just realtor knows two people, plays matchmaker and does it. But in a national metric from realtor.com, we have 39 days. And that doesn't give people a lot of time if they have VA loans or other kinds of financing that might take a while. 39 days it can be a tight timeline. So we're seeing a lot of cash purchases and a lot of no contingency contracts and offers, and just getting deals done as fast as you can.
Yeah, and this is for investors. If you're looking at the days on market and you're seeing something like this, what this is telling you is you can't be relying on finding deals on the MLS, on Zillow, on something like that. You need a way to get homes before they're coming to the market, whether that's through a wholesaler that if you're into the buying under market, fixing up and renting out or selling, you need to find somebody like that. You can find somebody like Rent to Retirement who have providers who aren't even bothering posting their properties to retail buyers. They're just selling to investors. It doesn't matter where you're finding it necessarily, but just know this hot market, these days on market is showing you've got to have a plan to find your deal before it comes to market, because when it comes to market, it's gone at this point. And you're not even just 39 days on market down 30% year over year. That's not even talking about the bidding wars. I mean, if you want to get into a bidding war, have fun, best of luck to you, but I'm not going to be bidding against you. So, all right. So what else are we looking at? We're looking at active listings. Active listings are 640,716, down 26% year over year. And Sam, in your email to me, you had an interesting comparison here. Tell us a little bit about that 26%.
Yeah. Just to put this in perspective, I was thinking 640,000 listings. So if that's peppered throughout the entire United States, we know that there's millions of people in major metro areas. And so I said, what if there was one person per listing, like all of the houses in Washington, D.C. were for sale. And if one person lived in each of those houses, that's how many active listings there would be in the entire nation. So that's including Alaska and Hawaii as well. Think about that. So that is not a lot of listings, and not a lot of deals to be had if you're looking at that number.
Yeah, and especially you also let's delve a little bit into the construction numbers that you sent me. And this is the big thing that I don't think people are paying enough attention to. And that is the fact, and we've seen it, that builders just aren't building like we need. And they haven't been building like we need since the Great Recession. They got burned. I mean, they've come out, I've seen, I don't know if you follow John Burns's work at all and his demographic stuff. They've flat out come out with information saying their interviews with builders, they say, yeah, we're holding back. We're not going to build because we're well, first off, there's so much appreciation, it doesn't hurt them to wait. But second off, they don't want to get stuck like they did back in the Great Recession. And so we've just got a massive buildup. I talked with Zach about it in one of our other podcasts. I can't remember if it's come out yet or not, but Fannie Mae has said there's a $4 million $4 million home deficit in the U.S. And I don't know about you, Sam, but I don't see it being filled anytime soon.
Yeah, it takes a while to build houses. You can't build them overnight. I mean, we've gotten better construction technology and prefab and tiny homes that are just ready to roll onto your lot. But when people want real single family homes, it takes a while to build them. 6 months, 8 months. Especially with how busy these contractors are.
Yeah, and you got to find land. I mean, that's the other problem in today's environment. You talk about prefab houses, which could be a solution, but those are hard to get loans on. A lot of lenders don't like. They're very anti-manufactured homes. You might have to put down a significant chunk over your 10 or 20%. You might not even be able to get a loan from a straight bank for prefab homes. They have a bad reputation, even if they're quality product. So just letting people know about that as a potential downside to the prefabbed homes. So
definitely. And we have recently, in just the last month or so, there has been a pretty decent pickup in construction spending for single family homes. We're up 47, well, big time from a year ago, at least, because everything kind of came screeching to a halt with building when COVID first came on. All the mills were shut down for lumber, but now lumber prices have kind of stabilized and come down from their prices. I mean, it was as valuable as gold, right in the middle of COVID. People were stockpiling plywood and all that stuff. But now that the supply chain kinks have been ironed out a little bit, construction's picking up again.
Yeah. And I mean, just so people know, I don't know if they've followed the numbers a lot. Back in like March, April, May of 2020, the yearly rate of new home construction dropped under 1 million. It got down in like the 800,000-900,000 range, which I believe 40 or 50 year historical average is somewhere around like 1.6, 1.7 million. And we really need it probably to be closer to 2 million for several years for us to really get back to, the state of inventory that we need. So, seeing it bump up 47% from a year ago is great. But I think right now we're somewhere around the historical average now. And we need more. It's great that construction spending is kicking up. It's great that lumber prices are coming down, because that will hopefully slow, some of that. It's even better. I mean, even if lumber prices stay high, it's even better that the supply chain issues are starting to get ironed out, because, I'll take expensive lumber that you can actually get over, inexpensive lumber that doesn't exist. So I think most builders would go for that. So, and let's talk a little bit about who's buying the homes, because you sent me, or actually, no, let's go into what you can actually rent for it, because this one goes along with home prices a little bit more than that. We'll get into who's buying them in a second, but we're going to go into the average rent that we're seeing here, and this is great news for investors. Why don't you walk us through this a little bit, Sam?
Sure, definitely. So as our average rent nationwide, we have it $1,575 a month, and that's our average rent. So, there's some really high end stuff that rents for $50,000 a month here in Jackson Hole. That obviously brings that up. But, and it's tough to get an exact measure as far as just to think in your mind, is it a studio? Is it a 2-bedroom? So this is an aggregate measure of all those things. But we're seeing an 8.1% year over year growth in rents, which is pretty unprecedented. I think that's record setting. And just in this previous month in August, we saw a 2.1% increase. And so that's great for landlords that have locked in 30-year fixed rate debt on their investment properties, because that mortgage payment stays the same, but their rent is chugging up, which is awesome.
Yeah. And I want to also mention, when you're leveraging this 8 point, let's say you're not as aggressive in your rent increases with your tenant. Let's say you only raise your rent 6% in a year. Now that is raising your rent 6%, but remember, you only put 20% down. Your cash flow is going from, let's just say $300 a month to $360 a month, 370, that's a, 30% change. That's a significant jump in your actual returns. Remember, leverage is your friend when done correctly. That's why we work with the lender and make sure they understand exactly what we're doing and help us get to the best point we can be. And this rent increase is really a multiplier effect whenever you spread it out across multiple properties. So keep that in mind as well. Yeah. And so it looks like good news across the country, right?
Oh, most definitely. Yeah. So not only have we gotten back to pre-pandemic rent rates, but we've actually exceeded them in a lot of the metro areas. So anyone that was saying cities are dead, according to this, they're not.
Yeah, and cities got hurt for a while. Yeah. Suburbs got a boom. That was very nice for investors who've been investing in the outskirts of town for a while. Those suburbs that are 20, 25, 30 minutes away. Those I would say that those have really helped the rent increase year over year because my suburban properties have been able to significantly increase in rent over the past year. So, cities are on the comeback, but don't leave the suburbs yet. So, All right. So, Sam, who's actually buying these properties?
Yeah, this is interesting, and Adam, I'm sure you have stuff to say about this because you are in that largest red bar there for millennials. But so we're looking at a graph of mortgage originations by age, and this makes a lot of sense because when people are getting into their 30s or later, they're starting families, and even in this orange bar here, late 20s, starting families, looking for homes, want to borrow money. And we've seen the millennials just absolutely take on tons and tons of mortgages because they're the biggest demographic since the baby boomers. And they're looking for a place to call home, set up shop with their family, and have peace of mind knowing they're not going to get kicked out of their current rental situation.
Yeah, we've been waiting and waiting and waiting for the millennials to really jump into the home buying world because, as a millennial myself, it's barely a millennial. I should say. I think I was in like the first or second year of millennials. It's been rough. We came out of high school and into college, and if you weren't going to college, you're trying to get a job right at the .com bust, and then we got came out of college thinking, oh, maybe I'll buy a home. Then there's the Great Recession, and then a lot of people start saving up, and then there's COVID, and it's been home ownership for millennials is a bit scarier. But it's good to see that the 35 to 44-year-olds are now making up about 35 to 36% of primary residence mortgage originations. I believe this is in the San Francisco area of California. It's probably nationwide about the same. You really get the prime. You're getting towards your prime earning years when you're around 40. But you also have a lot of them coming out, and finally, we came into good paying jobs. We've just been having to save up and save up and save up to actually afford this $380,000 median price home. So it's taken a while, but we're finally getting there.
Yeah. I feel for the front end of the millennial generation and that .com boom, and then in the more recent end, the younger end of the spectrum, they came out of college right in 2008, 2009. No one was touching real estate then. It seemed really risky, but now that they're coming into that prime home buying age, I'm hoping they can take out some loans here and put a deal together.
All right, so Sam, let's ask the question that probably most of the country is asking themselves, and that is it still a good time to buy a home? What do you think?
I would say it depends on your goals and your time horizon, right? So if you're retiring or you're just kind of getting ready to enjoy your life and you only got 10 years as far as your investing goals, you may not want to buy a home right now. However, for the majority of us, interest rates are at historic lows, and it would be a great time to buy a home and lock in that really low interest debt.
Yeah, and you also have to think, if you can get in to a good market at a good price and lock it in, you also get a lot of, property tax potential benefits. Like here where I am in Austin, you limit your property tax increases as soon as you get that homestead exemption, which allows you to save money over time as your taxes don't increase year over year quite as much, and which then allows you to, potentially, as you get towards wanting to pull out cash from your home to invest, save yourself money in that regard, because you're able to refinance, it doesn't even really matter if your loan goes up, if your loan rate goes up, if you're pulling that money out to get you a better return. It's even better if you can wait and get a lower rate, which I never thought I would. We bought our home at 3.5%. I thought there's no way I'm ever going to get lower. We refinanced last June and got a lower rate and pulled money out. It was incredible. It was fantastic. I highly recommend everybody, if you own a home right now, talk to your loan officer and see if you don't have one, or if yours isn't giving you good advice, talk to us. We will help you find a loan officer who will work you through this, because if you can pull money out and get the same or a lower rate, and you can put it towards something, I'm personally still all in on real estate, but even if you're not going into real estate, if you can put it to something that's getting you a higher rate of return than you're paying in your, 3% rate, now's the time to do it. So I would say, don't miss out on that just because you're afraid that the prices have gone up a little bit. It's not the end of the world. And as we've been discussing, with the demand being there and the supply not being there, the fundamentals are telling you. People worry. They say prices have gone up. We're in a bubble. I will agree with the first half of that. The first half is prices have gone up. That is definitely true, undeniable. The bubble part, I don't agree with, because there is a reason prices have gone up, and that reason has not changed. Now, if we were in the same situation and we're building 4 or 5 million homes a year, that's a different story. We'll talk, if that actually happens, this podcast will sound a lot different when that does happen. But when we're still building 1.6, 1.7 million homes, I'm not going to change my tune. This, at worst, it's going to flatline and stay the same or go up, a couple of percent a year. But at the moment, I don't see what's going to change the fundamentals for us.
Yeah, definitely, Adam. I totally agree with you. And the fundamentals are there and really strong. And I'd also caveat my statement too. If you're getting older and you're in retirement phase, well, maybe an investment property is actually great for you if the rents are there and that can produce income that you can live on in retirement. So really, if your goals are to create or just preserve wealth and continue to earn income off of your investments, it's a good time to do it. And just to put it in perspective too, this is from the US Census Bureau. For the younger generation like me, we need to kind of learn from those people that have been through different cycles and understand how the fundamentals were different back then. And so in price or $80,500, but the interest rate was 18.45%. So that's showing you how different interest rates are now than they were back then. And after a monthly payment back then, if you put 20% down, your payment would have been a little over $1,000, which is the equivalent of a $2,500 payment today, adjusted for inflation. So that doesn't even include property taxes or insurance, et cetera. But now with our average home price or median home price being $380,000.
Sam? Sam?
Yep.
I think your internet cut out there. You said with the median home price being 380. I didn't catch anything after that. You're frozen on me.
Am I here now?
Yeah, you're grainy, but you're there.
Shoot. Should I start from a certain point?
No, yeah, you said now with the median home price being at 380. And then I missed what you said after that.
Okay. So, all right, I'll pick it up there. Try to keep it quick so I don't cut out again. So now with the median home price around $380,000, if our interest rate is 18.45%, like it was back in the 1980s, that's around a $4,000 a month monthly payment. So you can see just how extraordinary it is to have interest rates this low and how much sense it makes to buy real estate now.
Yeah, and I also want to tell people, based on what we've been saying about appreciation and rent increases, now is also a great time if you own real estate that you've been using for investment properties. Talk to your real estate agent in the markets that you own. Talk to us, talk to sellers, talk to your lender. It might be a time to refinance those properties or even 1031 exchange those properties, because if you've been owning, say you bought a rental property 6-7 years ago in the suburbs of Memphis or Indianapolis or something like that, there's a decent chance that your investment property might be worth twice what it was then, and you might be able to get a better return on your investment spreading it out across some more rental properties. So also, make sure you're talking to your local teams there and seeing if you can better utilize your properties there to make you more money. So I want to get to a little bit more of what we were talking about earlier as we get close to wrapping it up, and give neither Sam or I live in places where you would really want to be buying investment properties. I think that's a fair statement. So, but let's go into what the big cities have done. I'm going to go into, we're going to start with you, Sam. We're going to start with Jackson Hole. Tell us a little bit about what is going on in your market.
Yeah, so as a realtor, I need to read a lot of realtor.com statistics, because we are kind of a total red herring for the rest of the market. I mean, we do something, we do just, the fundamentals here are completely different. And the reason that is because Teton County, Wyoming, where Jackson Hole is located, 97% of the land here is publicly owned by the state of Wyoming, by the town of Jackson, by the federal government. We've got Grand Teton National Park to our north. So supply and demand is much different. We don't have any supply and we have lots of demand because it's so beautiful here. So just this year, our sales were up 86%. And the reason that is because in times of uncertainty, we don't know what's going to happen with inflation and all this money printing from the Fed. People, and especially wealthy people, are looking for a good store of value. And they definitely found that here in Jackson Hole, just with the scarcity feature of this market. Our single family home prices were up 45% year over year, which again is it doesn't make sense for the rest of the market, but the fundamentals are why that's happening. And people are also, a little bit scared of what was going to happen with the United States during COVID. We had political risk, we had civil unrest, and so people wanted to kind of build their own little fortress, family ranch where they could fly out here and nobody could find them. And so the reason, again, this price appreciation happened so rapidly is because people found that store value here and they didn't want to give it up, even though prices were skyrocketing. There just weren't that many listings on the market. We were down 55%, and it was just people saying, hey, we got our little slice of heaven and we don't want to let it go. And so that creates even more scarcity of supply, and prices increase. And our median sales price, again, just to show you how different we are than the rest of the United States and the rest of Wyoming for that matter, our median sales price was $2.75 million.
Jeez. So a mere 8 times the national average. That's yeah. Yep. People, a $2.75 million property is not an investment property. That is a straight appreciation play. So Jackson Hole, not the place you want to be as an investor, I would say. Now, I will say it's possible. It's possible that an Airbnb could work. I don't know the regulations around there. It's possible that a short-term rental could work there, but that's a whole different ballgame with a whole lot of different numbers than just your single-family rentals are. And now I'm in the Austin area, as I mentioned. We've got a little bit different world going on there. We're a little bit closer to normal. Also, as they say, keep Austin weird. Well, Austin's not quite as weird anymore because the median sales price is up to $480,000, which is up 37% year over year. We've got the inventory is what kills me. The inventory is 0.9 months. We really want to see that in an average nationwide market or whatever market you're in, you really want it closer to 6 months. We've got a ways to go before we hit that. Average days on market is 12 days. Like I said, that really, in some areas, I think I saw my realtor sent a thing a while back saying in some areas it was 2 days. A lot of times it's essentially just a weekend, 1 or 2 weekends, and they can get, I mean, there was one here, I remember everybody posting about on social media. One weekend, they got 97 offers. Over half of them were all cash, and it sold for like 20% over asking or 25% over asking or something. It's ridiculous around here. So it's just telling you, you need to know where to find deals. You need to know people to find these deals, and we can help you find the people here. And we can also give you properties that aren't ridiculous. Let's look at this one in Kansas City, Missouri. This one came out. It was recent. I'm pretty sure it's not available anymore, but it was recently. We get new properties here at Rent to Retirement all the time. You can contact us and we'll help you find these properties. But this one is $213,000. It rented for $1,750, which is above the nationwide average. It is expected to cash flow $562 with a cash on cash year one of 14.79%. These are numbers that are not unattainable. You can find them frequently through the network. They're harder to find elsewhere, like I said, but these are markets. This is a market that makes sense. It has properties available, and it's a whole lot less risky than going into Jackson Hole or Austin or New York or LA or something like that. And it's a lot more landlord friendly as well. So check out those properties and more. You can schedule a consultation with any of our investment counselors here at Rent to Retirement. Just head on over to renttoretirement.com. You can also check out all of our inventory there on the site. If you want to have the inventory sent to you on your smartphone by PDF, just go to renttoretirement.com/hotlist. You can get that on your phone every day. Sam, I want to thank you so much for joining me. I look forward to doing a monthly market update with you. Anything else you want to tell people on our way out?
Just stick to the plan with these crazy market swings and uncertainty. Just continue to stick to that long-term cash flow appreciation, equity buildup plan that we love here at Rent to Retirement. So
absolutely. And
crazy.
Yeah. And, even if you just talk to our investment counselors to formulate a plan, even if you just get a hold of them and say, hey, this is my situation, help me out. That's what we're here for. We'd love it if you buy one of the properties we have, but more than anything, we're here for education, helping you out, connecting you with the people you need to be connected with to be a successful investor. So again, check us out, renttoretirement.com. Thank you for joining us for today's episode, and we'll see you on the next one.